What is credit risk? Credit risk is a situation whereby the borrower is not able to make payment on the maturity date agreed. A default payment by one party causing the other party to suffer losses. It is a risk that should be avoided because if it happens, it will tarnish the defaulter's reputation. Credit risk or default risk involve the inability or unwillingness of a customer or counterparty to meet commitments to lending, trading, hedging, settlement, and other financial transaction risk or default risk and portfolio risk. The portfolio risk in turn comprises interest and concentration risk. Did you know the credit risk of a bank's portfolio depends on external and internal factors? The status of the economy including changes in commodities and stock price, foreign currency and borrowing costs, economic sanctions and government policies are all external variables, while the defects in loan policy, initiative and administration, the absence of prudential credit relative low concentrations, shortcomings in the evaluation of borrowers' financial condition, and post-sanction surveillance are among the internal factors. This is the summary of the article entitled Credit Risk During Inflationary Times. The Reserve Bank of India (RBI) hiked the repo rate to 4.90% on concerns that inflation may rise faster than expected. This increase was quickly passed on to borrowers by banks. The ramification must be through the lens of credit risk, especially during a time when banks' market volatility in some industries has grown as a result of improved growth forecasts. The State Bank of India's SBI chief economist forecast the repo rate to reach 5.5 to 5.75%. Loans to micro, small and medium-sized organizations (MSMEs) surged dramatically in May 2022 and more especially to micro and medium-sized manufacturing firms. This witness a slowing trend in the near future since credit risk for business will be back. Supply chain disruptions emerge of rising raw materials costs in both local and international markets, as well as high interest rates piercing the price risk in competitive marketplaces. Energy shortages are affecting critical manufacturing sectors in all but a few states. Recommendation to improve and control credit risk. Firstly, banks must ensure that the credit granting function is being properly managed and that credit exposures are within levels consistent with prudential standards and internal limits. Secondly, establish credit limits by negotiation with various parties, local and foreign institutions. As a conclusion, insufficient risk scoring models are indeed the major source of significant difficulties in the banking industry. Thus, credit risk management has gotten a lot of attention. Managing credit risk is thus an important and difficult company role. That's all from me. Thank you.